As the entire market is going up, I am looking for some investments, I am looking for some opportunities, and I am looking for some stocks that are not trading at a 52-week high. Basically, the forgotten stocks and what's available in the market right now. One of the companies that is coming to mind is Sofi. Now, Sofi is not trading at a 52-week low, but Sofi is trading at the bottom half of the 52-week low. So I think Sofi at mid $5 is close enough to the 52-week low of low $4 than it is to the 52-week high of just north of $8 a share. Now, to be quite honest with you, I had Sofi before. I had a small position in it. I sold out of that position when I needed to cover my margin a while ago, and now I want to get back into the stock. I didn't buy it yet. I think I will be getting into the position next week. And in doing so, I do want to start covering this company. I hate to talk about companies that I don't own, but seeing as I most definitely will be buying this stock, I think it is okay for me to speak about it. Let me give my personal community a synapse of the company. And before I go any further, I'm not a financial advisor. I am not advising you in anything, nor am I qualified to be a financial advisor or give you any advice. This is purely entertainment, and I am giving you my own personal plays. Please do your own research, do your own due diligence, and if you make money, you make money, and if you lose money, you lose money. And I am obviously talking about myself because I am not encouraging you to buy, sell, trade, or do anything else but to be entertained for the rest of this video. For anybody that doesn't understand, SoFi is literally a bank. They are a bank online. So instead of having brick and mortar locations, they are a bank. They have a banking license and they are doing banking shit. They are a bank for millennials. So everybody that is banking with them, not everybody, but for the most part, are young people. These young peoples in the future are going to need a lot of services like personal loans, mortgages, so on and so forth. This is where SoFi comes in. SoFi is huge in student loans. These student loans, after people graduate, they pay off their loans, then they need another loan. What do they need a loan for? They need a loan for a house. Well, what do you need after the loan for a house, which is a mortgage? You're going to need a home equity line or a personal line of credit. And all of this, in my personal opinion, is going to be going to SoFi. This is how SoFi is going to grow in the future. SoFi is only valued at $4 billion. And SoFi is starting to become very close to GAAP profitability. And we all know what happened to Palantir once they hit GAAP profitability. For everything that I'm mentioning right now, this is why I am doing more due diligence into SoFi. Now, I'm not an expert, but I'll give you what I have for now. And as I cover the stock a little bit more, as I understand the company a little bit more, I'm going to be able to give you guys more information as well. So revenue of SoFi actually beat. It came in at $460 million. Their high estimate was $440 million, which means they are going at 43% per year. They also beat EBITDA at $76 million, and they were expecting $45 million. For quarter two, they are guiding $470 million, which means they're going to be growing 32%. And for full year, their guidance is $1.9 billion to $2.02 billion, which is a 27 to 31% growth rate. Why am I telling you this? Because that is a very impressive growth rate by any metrics. They are in hyper growth mode. In terms of their losses was a year ago 14 cents. Their losses last time were 5 cents, which means that they are increasing by 64%. That means they are getting close to GAAP profitability. They were at a loss of $110 million. Now they have a loss of $34 million, which is an increase of 69%. Again, all this is leading to a path to profitability, specifically GAAP profitability. And GAAP profitability, if you guys don't understand, this is the generally accepted accounting principles. And these GAAP profitabilities is what Wall Street looks at to value the company. That's when you officially get PE. Until then, the metrics are all different and you're not considered a viable, profitable company. But the key is to invest in companies that you believe will be GAAP profitable and successful companies in the future before everybody else jumps in on them, i.e., what's happening to Palantir right now. Now, I'm not saying this is going to happen to SoFi or this isn't going to happen to SoFi, but it's at least worth a look. And I like that SoFi is not trading at a 52-week high, and there's many reasons for that, which I'll get into in a different video. But for the most part, there was a short interest report that came out. Well, who's reporting against SoFi? Traditional banks. Well, who gets hurt the most from SoFi? Traditional banks. Do you see where I'm going here? Their members grew 46% year over year, and the average over 2 years is 78% growth, which means they are still growing at an exceptional rate at 46% when the 5-year average was 78%. Their lending is up 24%, and again, the last 2-year average, their lending is at 18.9%, so they are actually higher than their 5-year average, which is beautiful. Financial services is up 51%. 5-year average, 157%. So again, all their metrics are not only good quarter over quarter, their metrics are still extremely strong, even from 2 years ago when they were in super duper hyper growth, right? If that makes sense. But now they're getting closer to GAAP profitability, and they're still growing at an exceptional rate. Anthony Noto is the CEO of SoFi. The other day, he went on an interview with JP Morgan Chase. This was a fantastic interview that I love to watch. It took 33 minutes, and he basically clarified all the shit that was on SoFi, all the shit talking that people are doing, all the naysayers, all the doubters. He basically took everything, he answered everything, and he knocked it out of the freaking park, if you ask me. I'm not the only one that believes this, and I believe I, like a lot of other people, truly did enjoy this interview, and this is why SoFi is now on the radar of a lot of investors, including myself. Now, I recorded this video right here, and I put in interesting captions below. Please enjoy the rest of this video. It is going to be a 33-minute interview, and this is specifically for my personal community that wouldn't know about SoFi in any other way. Thank you so much. Let me know in the comments down below what you guys believe about SoFi. And in the future, when I do buy SoFi, I am going to be making more videos on them. I'm just giving you my preliminary investigation, my preliminary due diligence. I highly suggest that you do your own research, but everything that I see about SoFi right now, I really like. Now, there are some holes in its games, and they definitely have some weaknesses in their Galileo platform, which we can get into in different videos. But all in all, let's say 9 out of 10 boxes checked for SoFi. Have a great day.
Good afternoon. My name is Reggie Smith. I cover fintech stocks here at JP Morgan. And I am pleased and excited to host Anthony Noto, CEO of SoFi, this afternoon. Format's going to be fireside chat. We'll start with some questions from me. I will open it up to the floor later on, and even check in online for questions as well. With that said, welcome, Anthony. How are you feeling?
Feeling well. Thanks for having me, Reggie. Thanks to JP Morgan as well.
Good. So we'll get right into it. Full disclosure, I am a SoFi member, and so I'm intimately familiar with the app and the services. Wanted to start by having you kind of share the SoFi mission for folks. I mean, I think it's helping people get their money right, and that really resonated with me. Maybe give a little background on the company and what you're trying to do and the problem you're trying to solve, and for who.
Sure, happy to. When I joined the company in early 2018, we reestablished the mission and really the strategy overall. And our goal is to help people achieve financial independence, to realize their ambitions. And essentially that means they get to the point that they have enough money to do what they want, buy the house they want, live where they want, size family they want, the career they would like, and when they can retire. And in many ways, someone today that's making $100,000 plus really struggles to live the American dream for a variety of different reasons, and they need a relationship bank. They need a bank, financial services company that can be there for everyday things, but also for all the major financial decisions in their lives. If they don't invest in their 20s, they're going to have a hard time catching up, and the amount of compounding they need in their 30s and 40s is really challenging. If they overspend on their college education, they're going to be in a hole and they can't invest. If they buy a home that's too big relative to their means, they're not going to be able to save, and they're going to constantly be running over budget. And so we want to be there for that relationship every day, and to be there for all their major things, which means we have to help them borrow better, save better, spend better, protect better, and invest better. And we focus on those verbs because that's ultimately what helps them get their money right.
Sounds good. That's great. You guys acquired a bank about a year ago, and in hindsight, it looks like, I don't know if it's luck or a stroke of genius in that with everything that's going on in the funding market, ABS and whole loan markets. My question to you, deposit growth has been on a tear of late. What's driving that growth and how sustainable? Can you talk about the trends that you're seeing in deposits?
A key to our strategy is building a primary relationship with a member so that we can be there and be trusted and be there when they make those decisions. And one way to drive primary relationship is having someone's direct deposit. And so as we started to architect our SoFi Money product, which is a checking and savings account, we thought through all of the needs that someone would have and how to differentiate that product so we could win their direct deposit. It'd be really hard to do that without a bank, so the bank enables us to provide a high interest rate on savings and checking. It allows us to avoid paying them fees. We're in control of the value proposition. We enable you technically to pay any way, any when, anywhere, any way you want. You can pay a friend, you can pay a bill, you can pay via check, you can pay via wire. You can access your money in real time. You can deposit cash from your phone through a partner. You can deposit a check through your phone. And that primary relationship then gives us insights into everything else they're doing to help that person get their money right. So when we launched SoFi Money after getting the bank license, we launched it with all those characteristics, and it's really helped us drive great direct deposit growth. We delivered $2.7 billion of direct deposits in Q1. And very little of that, if any, was from the fallout that we saw amongst other banks. It's really coming from the largest money center banks. And we continue to see a very strong trend in Q2 as well. We mentioned on the call that we expected to add $2 billion plus per quarter, and we're on track to do that. And the quality of those members is very high, with a high FICO score in the 715 range. And it allows us to have 90% of our deposits from direct deposits. And we also offer $2 million of FDIC insurance now. And that's allowed us to have 97% of our deposits that are insured.
That sounds great. There's two follow-up questions there. Are you surprised by the success of the deposit program? And then in addition to that, what's your capacity or like how large can that be? Do you have a sense of?
Yeah, I would say I'm not surprised by the success of the amount of acquisition we've had or the deposits. The thing that has been higher than I expected was the percent of the new funded accounts that are direct deposit. It's averaged around 50%. Typically, it's about 35%. So the conversion of funded accounts to direct deposit accounts has been higher than expected. It was a key part of the strategy. We want to build that relationship and be there for the next second and third product. The cross-buying that we're seeing from that customer is very high as well. So it's really worked quite meaningfully. In terms of how we think about size, we really start with the end goal that we think drives shareholder value, which is return on equity and return on invested capital. And we want to drive well past 20% ROE and over 30% ROIC. That's going to be dependent on the mix of businesses that we have and the capital intensity of those and how well we run them. And so the way I think about it is that we have a lot of flexibility in our bank charter. Our bank holding company leverage ratio, equity to assets, is 17%. That can go to the low double digits. We have an ample amount of our own equity capital and funding capacity. And so we can continue to grow the member base through checking and savings, which will grow deposits, and we can deploy those deposits efficiently at this point in time. Over time, we may allocate more of the capital to investing or to products outside of checking and savings as an acquisition vehicle into technology partners or launch new businesses. But right now, we have a lot of runway, and it's really benefiting us.
Yeah, sure. No, that makes sense. I wanted to talk about your personal loan. You guys have become a major player in the personal loan space in the last year or so. What can you tell us about, kind of the approval rates, your underwriting posture, APRs, loss expectations, any insights you can share there? Obviously, investors are very keen and sensitive to that business right now.
Sure. One of our core values is to learn, iterate, and innovate. And so we're constantly talking about testing and learning. So even outside of this environment, we're constantly testing pricing and credit to make sure that we're managing our lending within the credit box that we've established, which we haven't changed. We underwrite 680 FICO scores and above. We actually don't underwrite the FICO score. We underwrite the cash flow. And so we're trying to predict the cash flow of that person when we're approving them. Because we're in a premium credit box and a prime customer, we actually decline about 70% of the applicants for our personal loans. Because if you're below 680, it's a knockout. But then within that box, you still have to have a very attractive credit profile for us on a cash flow and debt perspective. So we only approve about 30% of the people that apply. The other 70%, we actually do monetize a portion of them through partners, and it's a great relationship with other underwriters that are in that credit box. We've been able in this environment to pass on the higher cost of interest rate. So we call our coupon weighted average coupon, and we've been able to pass that on in higher pricing and maintain a great credit profile. We've actually tightened credit. We use a number of factors in deciding what the economic environment is, and we look at macroeconomic indicators as early warning signs, and we've used that to tighten credit throughout the last year, and we're still tightening it now. Our forecast in terms of what we think about the economy and what we factor into our credit models is based on Moody's S3 forecast, which assumes about 5% unemployment in 2024 and about 2.5% of GDP decline. So that's factored into it as well. So still approving around 30%, have tightened credit, have improved quality of credit. Our life of loan losses and annualized losses have been well below our tolerance threshold, so that's been really positive. Last quarter, we reported 2.97%, and we factored in a higher rate than that in our marks. So it's been a great business for us, but we've stayed really disciplined.
Got it. Is there obviously you guys have maintained your underwriting standards, but have you seen a share pickup in just applications as other issuers have or lenders have pulled back from the market? Anything of note there?
We have gained share, but I would attribute it more towards our ability to have faster time to fund, have attractive pricing, and really efficient marketing. We have our time to fund on a personal loan down to 2 days. When I arrived at SoFi, it was about 7 days. And so when someone wants to borrow money and when they want to do anything with money, they want it to be fast and efficient. So great pricing, great selection. We just added an option that we could do fees to get a lower rate if you'd like to do that. That's all contributed, but the quality stayed really, really high. We're at a FICO score of about 750 and an income of about $160,000.
Got it. I wanted you touched on the loss rates in the portfolio today. I think just about 3%. I know you guys are planning for something in the 4% range, at least in your fair value assumptions. How should we think about that number trending? I know there are a lot of things going on there. The portfolio is growing, it's seasoning, but where could that 3% go, just to kind of frame that for folks and get us ready for that?
So the 3% is an annualized number. On life of loan, the duration's around 1.5 years, so that'd be about 4.5% life of loan loss rate. That's well below our tolerance of 7 to 8%. So when we think about underwriting and think about valuing the loans and the yield that we can get, if we hold the loans versus selling them, we think about that 7 to 8% range. That's not what we're currently at, but that's the tolerance that we have. So, the credit could, be 50 to 70% higher from a life of loan losses before it hits our tolerance. So the credit's been performing really well, and our team's done a great job.
Perfect. I wanted to move on to accounting. There's been a lot of focus on that lately. You're one of the few banks that uses fair value accounting. Can you explain why that makes sense for SoFi, and whether or what, if anything, would precipitate a change in your accounting? And then just thinking about getting investors comfortable with the fact that there aren't explicit reserves. Like, what do you tell investors on that?
Sure. So on this point, we have two choices when we originate a loan. We can elect fair value or at cost accounting. Our company, since before I joined, has used fair value accounting. There's a bunch of reasons for that, but I will tell you, I think it's the best way to account for a balance sheet company that's using loans, because those loans have to be marked to market. If you do at cost accounting, you have to take a CECL charge up front. That charge gets adjusted over time based on losses and life of loan losses, et cetera. But the balance sheet and income statement do not change based on interest rate impacts or spread impacts and prepayment impacts, et cetera. In fair value accounting, you can choose held for sale or held for investment. We've chosen held for investment. Under that accounting, under fair value, we mark to market our loans each quarter. We make changes in those loans based on the change in WACC, the change in interest rate, the change in spread, the change in prepayments. Every factor that could change its value, and we have to recognize it real time, and it flows through our income statement and our balance sheet. At cost accounting, companies could report an equity balance that's positive $18 billion on a Monday, and a week later actually be taken into receivership because they don't record the unrealized loss in their balance sheet or their income statement, and it's not as transparent. Fair value accounting is much more transparent, and it actually marks to market those underlying assets. And so that's what we use. In terms of any changes, once we elect fair value accounting, there's no way the accounting on those loans are going to change. You can't change from fair value accounting to cost accounting on a loan once you've elected fair value accounting. Similarly, if you go from held for sale to held for investment, the accounting also won't change if it's under fair value. It'll change the designation in the balance sheet from held for sale under fair value held for sale to fair value held for investment, but the actual accounting would not change since it's under fair value. In terms of losses, I think this is probably the most misunderstood thing. When we mark a loan based on held for sale on our books, it actually is assuming a loss for that loan, and then it actualizes over time. And so when we talk about a 2.97% loss rate on the loans at the end of Q1, when we marked our loans at the end of Q1, we actually assumed a higher loss rate going forward than that 2.97%. In fact, we've actually assumed about 4.5 to 4.6% based on the outlook investors have for losses and the economy. So there is an allocation for loss in the mark. More importantly, once a loan goes 10-day delinquent, we write it down by 35% through the income statement and balance sheet. Once it goes 30 days delinquent, another 35% on the original amount. So after 30 days delinquent, we've written that loan down by 70%. At 90 days, it's written down by 90%, and then at 120 days, it's written off completely. And so not only are we taking a loss assumption in the mark, we're actualizing it based on the delinquencies as they happen over time.
Understood. And so if I'm hearing you correctly, what we should be focused on and super sensitive to would be the delinquency rate that's coming through the portfolio. That's something, a trend that we should be tracking as investors.
I would say you really want to track all the things I've mentioned. And the reason why I say that is if you think about interest rates, they've had a more pronounced impact on the value of loans on a balance sheet than any other factor in the last year. And because we do fair value accounting and therefore mark to mark, if we did not hedge our interest rates on our balance sheet, we'd be taking big hits on interest rates going higher against our fixed rate loans. But we do hedge our loans, and so that hasn't happened. So I wouldn't point you to any one of those metrics. I would point you to the totality of them because that's what impacts the value of the loans each quarter. And we actually mark them monthly, internally, then externally, reported on a quarterly basis.
Understood. And just a quick point of clarification. I think you said they're classified as held for investment. Did you mean held for sale?
Yeah, I meant held for sale, sorry. So fair value held for sale is the way we've classified those. We do have the ability to go from fair value held for sale to held for investment, but it wouldn't change the accounting.
Got it, thought so. Speaking of sales, got to ask you, a lot of focus recently on the fact that you've not been selling loans. What do you tell investors about that?
Yeah, the first thing that we say when we're asked about holding versus selling and investing in any of our businesses is that we're really focused on optimizing our return on equity and return on invested capital. And so when we have a choice to sell a loan at 104 or hold it at 106, we're thinking about what is the ROE. And again, we have to also factor in where are we in our leverage ratio, where are we in our ability to fund loans, and making sure we have the right balance sheet risk management. As long as we have the leverage ratio, that's 17% versus being in the low double digits, we have capacity to continue to fund. We have $3 billion of equity, $8 billion of warehouse lines, $5 billion of it's unused at the end of Q1. And in addition to that, we have $10 billion of deposits. If we have room on the balance sheet, we have liquidity, we have funding capacity, we have the option to choose the best yield or best return. And so more recently, we believe we can get about a 6% return on assets by holding the loans versus selling them at a 4% return on assets. And if you think about that on an ROE perspective, that's about a 43% ROE if we held versus a high 20 if we sold. And so that's what's driving the decision. We've been in periods like this in the past where we're in a rising interest rate environment followed by a declining interest rate environment where we've made the same decision. If you go back to 2018, Fed was raising rates throughout the year. We were doing asset-backed securities deals then. the bids we were getting for residuals weren't attractive to us relative to holding them. We chose to hold those residuals during that time. Get to 2019, at the end of Q1, Fed's no longer raising rates. People thought they would be raised 4 or 5 times in 19. Didn't happen. All of a sudden, the bids for those residuals became stronger than holding those resids, and we sold them. So as long as we have the flexibility, we're going to pick the best return for the company. There could be times where we don't have that flexibility, but we don't see that in the near future, given how much capacity we have to fund, the liquidity we have, and where our leverage ratio is.
Got it. No, so that makes sense, and I guess it really falls back on just kind of the credit quality, and so what can you share with investors about, I guess, like how do losses occur in the personal loan portfolio? I think people are familiar with credit cards and how that works, but maybe talk a bit about the loss curves and give people comfort that yes, the ROE is great, but like how do I get comfortable about with the risk exposure there?
Sure. I start with, have we stuck to our discipline in our credit box? And we have. We haven't gone below 680. As I mentioned, we've tightened our credit box. We're constantly testing pricing versus credit and the performance and looking at all the leading indicators. And the credits have performed quite well, especially on a vintage basis. And if you look at those curves after month 1, 2, 3, 4, 5, it'll show that we're on track to, be very much below our tolerance at 7-8% life of loan losses. As I mentioned, it was 3% annualized in Q1, and then we were factoring in 4.5% annualized, in the marks that we have. And as long as we stay below that level, then there's no issue. But that's essentially the best way to track it.
Got it. Shifting gears to the tech platform. Sounds like you guys have kind of expanded your aperture in recent quarters, moving up market to maybe bigger financial institutions. Can you talk a little bit about that and what gives you confidence or what you're most excited about there and how quickly that can grow and be margin accretive?
I couldn't be happier with the positioning we have at the tech platform. Having a processing capability with Galileo, a core capability with Technisys has put us in a sweet spot of capturing the secular demand for modern technologies for financial institutions, but also large customer bases of non-financial institutions that want to enter into the sector. We were not in conversations with large banks in a deep, real way prior to buying Technisys, but with the combination of both Galileo and Technisys, we're in conversations with a dozen plus large financial institutions that are facing end-of-life technologies that they're currently using for their cores, and they have to stand up a new stack. In addition to those large financial institutions, we have a number of other partners that are interested in modernize their technology stack because they want to have real-time asset and liability management. If you look at what happened with Silicon Valley Bank and First Republic, one of their biggest issues was not having real-time asset and liability management. We can see our deposits in real time by the minute. Not only can we see our deposits real time in terms of coming in and coming out, but we can tell you by customer segment what's happening and what those behaviors are. And that's a huge advantage in the world that we live in now where things can happen so quickly. So the pipeline that we have in the technology platform is very robust. These are going to be much bigger value-driving partners than what we've had in the past. They have installed bases that are large, and it will just be a matter of them switching over to the new platform. And these relationships aren't about building the new stack and converting 10 million or 20 or 30 million accounts over in one day. It's about building a new stack, onboarding new customers to that stack, and then migrating the existing customers over time to that stack. So I'm really confident that you'll see an acceleration in revenue growth in the tech platform, our revenue throughout the year. You'll see modest sequential growth for the next couple of quarters, and by the back half of the year, we should be back to mid-teens to 20% growth. There's two reasons for that. One, the pipeline that we're adding. Two, the current trend in our existing partners. And then three, we'll be anniversarying some partners that moved off the platform in the back half of 2022, and we'll be anniversarying those easier comps. But the robust growth that we have in the pipeline is the strongest we've had since I've been at the company. We look at TCV, total contractual value over the lifetime, and it's at multiples higher than it's been at any point in time.
Got it. Sounds good. We've got about 14 minutes left. I want to sneak two questions in and open it up to the audience. It wouldn't be a tech conference without talking about AI, and so I want to hear what you guys are doing with AI. And then wanted to hear more about the travel offering you guys just announced within the SoFi Money app as well.
Sure. So as it relates to AI, the places that we're using it today is on the tech platform. We have a product called Connecta. It's a natural language AI chatbot that helps with customer service. SoFi has actually implemented it. It was part of the Technisys acquisition, and that was a competitive RFP, and they chose Connecta. It's also something that we're going out to pitching to partners, and we've had great attach rates for Connecta that's using that AI capability. It helps reduce the contacts per customer. It helps increase improve time to resolution, and it lowers cost per contact. And so it's a direct bottom line driver, but at the same time also an improvement in customer service and customer satisfaction. So that's one place that we're using it. Second place we're using it is in the member home feed on SoFi. We're trying to answer 3 questions for you every day. What must you do that day in your financial life? What should you do and what can you do? And we're using AI and machine learning to personalize that home feed for you. We're also using it to make better personalized offers to you based on what we see from products like Relay and your checking and savings account. And the number of applications that AI can be implemented in terms of cost savings and productivity savings and customer personalization are enormous. So we're excited about the prospects there. In addition to that, one of the biggest areas our customers and SoFi deals with is fraud. And it's the ability to implement technologies like our PRP product, which is payment risk platform at Galileo, to use all of the transactions, 8 billion transactions on Galileo in a year, to use those transactions to help our customers approve authorized transactions and avoid fraudulent transactions is really valuable. The application of AI to that data, to that queuing is also going to be very, very beneficial. So we're excited about how it can impact all parts of our business. As it relates to SoFi Travel, we talk about helping people save better, spend better, borrow better, et cetera. So spending is buying. Buying better is not just a function of having the ability to use your money where you want to use it, when you want to use it, to do it with a credit card or do it with a debit card to earn reward points, but it's also giving you better prices and better selection. So we partnered with Expedia to help people buy better and travel. So if you go to the SoFi app, you can see SoFi special inventory with SoFi member pricing on rental cars, on airlines, on hotels, vacation packages. When you buy, you'll get those discounted prices. If you use your SoFi credit card, we'll give you 3% back as well. Now, our rewards program is pretty robust. You can take your reward points on SoFi and redeem them into our invest product for stocks. You can redeem into cash. You can redeem into the invest account. And now you can actually use those reward points to redeem into travel as well. And you'll see us do this in more and more categories because we want to help you buy better by giving you great financial services products, but also an ability to use your reward points and then find great inventory, not just in travel, but you could see it in autos, you could see it in entertainment tickets, you could see it in sporting tickets, et cetera, down the road. And one of the things that hasn't gotten a lot of focus in the last quarter, given what's going on in the banking industry, is our financial services segment, which is growing like gangbusters. We did over $80 million of revenue, up 4x from where it was in Q1, and the profitability is improving quite dramatically there as well. So about half of our growth in Q1 was from lending and half was from non-lending, and you'll see that trend continue to go to non-lending.
Real quick, what products within the app are gaining the most momentum? Is it the trading stuff? Is it the...
Yeah, the checking and savings is growing the fastest. We report the numbers for SoFi Money in terms of total number of members. It's over 2 million now. Our SoFi Invest, which is brokerage and crypto and ETFs, et cetera, that's also over 2 million members. And then Relay is growing really dramatically, which is a great honeypot for us to use data to help you get your money right, is also over 2 million members. But checking and savings is the fastest growing, and we benefit not just from the deposits, but also we're annualizing spending quite dramatically now from a debit standpoint, but that's the fastest growing.
Sure. Any questions in the audience? Just wait for the microphone.
Hey, thank you very much for taking the time and fielding the questions. Just kind of a two-parter. On the personal loan side of things, are you seeing anything notable with respect to the idea of, fallen angels in the consumer space or anything lingering in like consumer FICO inflation? I think especially in the context of how this recession hasn't really hit each profession or each geography kind of the same. And then maybe a part two kind of related, like, is there any visibility on if you're seeing strategic like defaults among consumers? I think the anecdote I would use is if there's more visibility on the price of an asset like a Tesla, that price has changed. Are people doing the math of like, oh, maybe the loan's higher, but given the asset price change, maybe I should just default and get a new car or get a new thing? Thanks.
We're not going to be a great data point for those types of changes because we're stealing market share from existing markets. So we're not going to have a big cyclical component to what we're doing. If you think about our growth in deposits and just deposit itself, it's bucking the trend that other banks are seeing. We're adding over $2 billion of deposits a quarter. We're growing the whole financial services segment by 4x. So it's a secular trend of market share stealing. The second reason is we have a high-end customer. As I mentioned, our average FICO score for personal loan borrowers is 750, household income is 160,000. So it's not your average consumer. And even in checking and savings, our funded accounts FICO score is about 715.
Any other questions? We have one right here.
Thanks for taking the time to speak with us. I think the growth in the checking and savings product is really remarkable, but could you maybe talk more about the engagement trends or the attach from that user who then goes on to use other products?
Yeah, we are seeing really positive cross-buying trends. And so, we love to bring members in through SoFi Relay, SoFi Money, SoFi Invest, because they are high engaged daily use products, and then they cross-buy to other areas. We've seen cross-buying rates that have been really strong in lending. It's historically been in the mid-20s, and that's still the case. The benefit we get when someone comes in through a low CAC product like Relay or Money or Invest is that we don't spend $800, $900 in acquiring them for the loan, and that doubles the profit in the loan. So one of the things that's driving profitability in lending is the fact that 25% of the loans don't come with a customer acquisition cost, and they come at 2x the variable profit per loan. So that's really positive. I would say SoFi Money is the biggest driver of cross-buying. Invest is actually the biggest beneficiary of cross-buying. It's been, in the 40+% range of our new Invest members coming from existing members. Home loans historically has been really high as well. That's been about 70+% of our home loans come from existing buyers. We're really excited about the home loan business now that we've bought Wyndham. We can have the technology capabilities in the back end to really scale that business. So you'll see the home loan business accelerate in the back of increased investment and the capability to better serve our members and reduce time to fund on purchases.
I got a few questions online. I'm going to combine them. Seems like one is kind of how does the business perform in a declining rate environment? And so I guess the expectation is that the Fed will cut rates in the back half of the year. Questions about what impact that may have on your derivative positions in the company as a whole. The second question is, what gives you confidence in your fair value marks for some of these loans and whether or not you could sell them at the prices that you're currently carrying them?
Sure. On the first question, we've lived through higher rates going to lower rates, then higher rates again, and eventually going lower. What we saw when rates were low is that our student loan refinancing business really benefits as people can refinance their federal loans into lower rate loans and capture savings there. So that business would be very robust in a lower rate environment. Lower mortgage rates would also invite more refinancing, and that business would be really robust. We also see a pickup in our SoFi Invest business as there's less yield or less income from fixed income assets. People move back into equities, and so that benefits that business. And the credit card business with lower rates generally benefits because of the variable rates and the cost of it going down. In high rate environments, personal loans benefit and checking and savings benefit. There's still good demand for student loans in the private sector, given the federal student loan moratorium has existed. But in a lower rate environment, we'd see a substantial pickup in a number of our different businesses on top of the secular trend that we've already seen. And then from a value standpoint, we hedge our interest rates that are on our balance sheet. But as rates go down, generally, if you do not pass on the decline in rates in WAC, then you get an even better value for your loans. And so in an environment where we see declining rates and we can maintain our weighted average coupons, the value of loans would actually go up. If we lower our weighted average coupon faster than rates go down, then value would go down. But in an environment when rates go down, people generally hold on to the weighted average coupons longer than you would anticipate. On the checking and savings side, we would be competitive and keep our rates in the top tier, but they would likely come down as well and just lower the cost of funding there also. As it relates to fair value, our confidence is what we actually see in the loans and what we can see in the marketplace. We did an asset-backed security deal in Q1. We did an asset-backed security deal in the fourth quarter as well. And that helps inform where spreads are, but also helps inform where overall demand for the loans. And we also use comparable deals, and we use a third-party valuation firm as well. And so it's a combination of what's actually happening in the marketplace and also what the macroeconomic outlook is and what we're seeing in other deals and hearing from buyers of loans. But as Reggie said earlier, if the yield return that we're getting on loans are higher by holding versus selling, we'll continue to hold them. And then you get to see each quarter what the actual performance is. This hasn't gotten a lot of attention, although we talked about it. Look at our net interest income line. It's a cash line. It's $200 million for lending. That's grown from about $50 million a year ago. And so that net income line, net interest income line will need to continue to grow if we're holding our loans. And you can see the performance of the overall portfolio as it relates to actualizing the performance of those loans based on that line as well as our charge-offs.
Got 2 minutes left. I'm going to close out, and these are kind of related. New products and initiatives that are on the come, if you can share that. And then kind of where is SoFi 5 years from now? Like, where do you see the business and the kind of 5-year goals? Not guidance, but just where the business can go.
We've been adding about 400,000 members per quarter. I expect that number to grow. And I think by 2024, 2025, instead of adding 400,000 members a quarter, we could be adding double that, maybe even close to 1 million. And so as I think about the scale of our business, it starts with members and then products per member and then the value we generate off of each one of those products. So 5 years from now, I'd be really disappointed if we hadn't added a significant number of members. We reported last quarter at just over 5 million. If we start adding 1 million a quarter in the next couple of years, we could easily be in the 20 million plus member range. I would hope that we have at least 2 products per member. That means some are at 4 and some are at 1. And I would hope that we were well in the top 10 financial institutions as it relates to banks from a scale of market cap as well as other measures that people use to rank banks. We will not just be in the United States. Today we operate in LATAM primarily through our technology platform. And we have a small business in Hong Kong for SoFi, but I expect SoFi to be outside the United States as well, likely in LATAM first, given we already have a presence there with a technology platform. And I hope to be a top 10 most valued brand and most admired employer.
Sounds good.
Thank you, Reggie.
Good luck.
Thanks,
Thank
Reggie.
you.